Fixed maturity plans. Debt funds, or fixed income funds as they are also known, are considered to be less volatile as compared to equity funds. Typically, debt funds are considered more stable as they limit the risk taken on the investment. They could be seen as alternatives to traditional fixed income investment options like fixed deposits, etc. Debt funds can be classified basis the time horizon or period of investment chosen, or basis the type of debt securities they invest in. Debt funds could also be classified by liquidity as open-ended funds, close-ended funds, and interval funds. This video will familiarize you with close-ended and interval funds, which in case of debt funds are called fixed maturity plans. On the basis of liquidity, debt funds can be classified as follows. 1. Open-ended funds. As the name suggests, these funds are open for investors to enter or exit on any business day. Units of open-ended funds can be bought at NAV, net asset value, and sold at the prevailing NAV less exit load, if any. In simple terms, such funds have a start date, inception date, but no end date. The number of units of an open-ended fund keeps changing because of the constant purchase and sale of units. 2. Close-ended funds. These funds have a fixed tenure and maturity date. Their units can be bought directly from the fund house only during their NFO period at the time of their inception. Interim liquidity of close-ended funds is available through listing and/or trading on stock exchanges as mandated by SEBI regulations. However, such liquidity is very low. Sale or purchase price of units on the stock exchange need not be same as NAV and could be higher or lower based on demand and supply. Since the fund house does not buy or sell units during the fund's tenure, number of units of such funds remains constant over their tenure. 3. Interval funds. Combines features of both open and close-ended funds. They are largely closed-ended but become open-ended at pre-specified intervals. Periods in which interval schemes become open-ended are called specified transaction periods or intervals. During these periods, repurchase and/or redemption of units is done by the fund house at the prevailing NAV. For instance, an interval scheme might become open-ended between January 1 to 15 and July 1 to 15 each year. Here too, the units have to be compulsorily listed on a stock exchange as they operate like close-ended funds, but investors do not have to completely rely on stock exchanges for liquidity of these units. Fixed maturity plans. An overview. Fixed maturity plans or FMPs are close-ended or interval debt funds. They invest in a variety of debt instruments like certificate of deposits, CDs, commercial papers, CPs, government or corporate bonds, etc., wherein the portfolio is closely aligned to the maturity of the scheme and does not change during its tenure. The fund manager in an FMP has little ongoing role once the portfolio is bought. They are generally compared to traditional assured returns products, though they cannot assure any returns. Fixed maturity plans. Key features. 1. Spread across tenures. FMP's maturities vary from a few months to a few years. They are also available as growth and dividend options. 2. Low interest rate risk. FMP is not impacted by fluctuation in interest rates during its tenure, as the yields of the underlying securities are locked for this period. Investors may prefer to buy FMPs to lock the higher yields till the maturity date. However, investors should be aware that FMPs do carry credit risk. 3. Tax efficiency. Like open-ended debt funds, FMPs score over traditional assured returns products as they offer indexation benefits wherein long-term capital gain tax is payable only on those returns that are earned over and above the inflation rate. For this, the holding period has to be over 36 months. FMPs are more popular for double and triple indexation benefits. 4. Relatively low expense ratio. Since these instruments are held till maturity, there is a cost saving with respect to buying and selling of instruments, thereby resulting in a lower expense ratio for investors. Let us look at the taxation element of the fund in more details. This illustration shows how indexation works with FMPs for holding periods above 36 months. and compares the same with the traditional fixed income products where no indexation benefits are available. Let us assume an investment of rupees 1 lakh was made for 1104 days or 3.02 years during financial year 13-14 and redeemed during financial year 16-17. Thus, an investment made for just above 3 years in financial year 13-14 and redeemed in financial year 16-17 is actually spread across 4 financial years and qualifies for indexation benefits as explained in this table. Thus, indexation benefits have resulted in lower tax outflows for the FMP investment, and the post-tax returns of 7.64% are relatively higher than traditional investments, where indexation benefits are not available to the investor. In case of the traditional investment, post-tax returns are 5.66%, assuming the investor falls in the highest tax slab. Investors who want to lock in the prevailing interest rates yield over a fixed period of time can go for FMPs. They are ideal products for investors who can lock in their money for the designated period or have an investment goal whose time horizon matches the tenure of the FMP. Those looking for tax-efficient debt products vis-a-vis traditional products can also start looking for FMPs. Investors who want to lock in the prevailing interest rates. For interim liquidity, FMPs are close-ended funds and can only be traded on the stock exchanges, where they are listed. In case of interval funds, units can be sold to the fund house during their interval periods. Please note that one needs to have a demat account to trade on stock exchanges. For those who hold till maturity, the proceeds will be credited to their bank account on the maturity date. For more information, please feel free to contact your mutual fund distributor or registered investment advisor. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.